We have a few problems to work in Chapter 16, but as I said before, if you just do the setup, it's really not that difficult. Here we have pre-tax accounting income. You know that is net income before taxes of 10 million, and we have only one temporary difference, meaning they have no permanent differences. And they have taxable income, which is what the tax form shows, of 7 million. We need to get from 10 to 7. So how do you get from 10 to 7? You subtract 3. So you would be tempted to say, I have a deferred tax liability and that amount is 3, but we know it's not 3 because we need to think about the tax rate that is in existence, and we are going to use a tax rate, it says, of 40%. So this is an introductory, fairly easy problem here. When we do our journal entry, that's what I really want you to know. You'll have income tax expense, which is whatever you need to make your journal entry work. We have income tax payable, that's based on taxable income times 40%. And you have a deferred tax liability, which is the reconciling item, which is a 3, which goes in between the two, and it's a minus 3, so it's a liability, and it's times 40%. The two combined give us the 4. So 1.2 plus 2.8 is 4. Here we have a concept type question, and it says the Board of Directors is concerned that the income statement shows income tax expense of 12.3, but the income tax obligation, so that'd be the tax payable, is only 7.9. How can the controller explain it? Well, so before we took this class, we thought it'd be tax expense, which should be equal to tax payable. So apparently this board member only took Accounting 201 and not Intermediate 2. He took Intermediate 2. He would know that there are tax consequences that are different due to timing, which create these deferred tax liabilities and deferred tax assets. So in that year, yes, it's possible that the difference could be showing up in a new item, but it also could be that previous year's items that are causing temporary differences are reversing as well. So in effect, we really don't know what specifically is going on with the company, but we are going to say that there is a change in a deferred tax liability or a deferred tax asset that's causing our differences. So they say here, increase in a deferred tax liability, a decrease in a deferred tax asset, or some combination. Don't know the details, but we can say that it's probably proper and it's not improper accounting. Alvis reports pre-tax accounting income of $400,000, and then they go down to $250,000. If you subtract, which is what you're doing, and be sure you put the net income number on the top and the tax form number on the bottom, you're creating a liability. And they ask a little bit of a different question though. So what I tend to do, and I tell my students to do, when they're preparing for the CPA exam or when they're taking an exam in my classes in financial, that they should do the setup first. And I'm going to say there's a minus of 150 there, and that minus 150 will create a deferred tax liability, the amount of which we have to calculate. Excuse me. So the question though is the tax rate. What is their net income? Well, net income is after tax. So you're going to say pre-tax is 400, and then I'm going to deduct 35%. You need to, before though you take the shortcut, you need to be sure there's no permanent differences, because the shortcut method that I just did does not work if there are permanent differences. So I tend to tell students, do the long thing, do a journal entry, and you're going to have, as we said before, a deferred tax liability. You're going to have a tax payable, and the tax payable is going to be based on taxable income, and then you're going to figure out what tax expense is. Once you come up with the tax expense, subtract tax expense from 400, and this will give you net income. What do you report on your balance sheet according to income taxes? You have a current item for your taxes payable, and you have a non-current for the other. So in this result, we are going to have a deferred tax liability for the 150 times the 35%. We are going to have income tax payable for 250 times 35%, and the total is income tax expense. And since we started out at 400, the 400 minus the 140 is 260 in the net income. As far as where these show up, deferred tax liabilities, the new rules say all of those should be non-current. Income tax, I expect, would be in the current liabilities. And that's the way I would like for you to say. It's a current liability. Now, and the answer here, the solution, did not update, and so I said you need to change it because all the non-current need to be netted when we do the financials, and you will call the deferred tax liability a long-term or non-current liability. So you can X out this business because GAAP changes, and GAAP changed, and the GAAP change says now all deferred tax accounts are non-current. And again, net them on the financials. What are permanent difference? A concept question. These are things that come about because of transactions or events that do not affect us in our payment of the differences between taxable income and net income in a way that is going to reverse. They are going to be constant differences, in other words. There's no reversal. They do not show up in deferred tax assets nor deferred tax liabilities. They are just differences that are reconciling differences between pre-tax accounting income and taxable income. How are deferred tax assets and deferred tax liabilities reported in a classified balance sheet? Whoa, look at how I changed. Look at how I marked it all out. Because this has changed. And starting in 2017, we now must net the liabilities and assets as long as they are for either the same jurisdiction or the same reporting entity. Valuation counts need to tag along. All of these guys are non-current. So you net them, you figure out if you have a deferred tax asset situation or a deferred tax liability situation. And keep those valuation accounts in there. This is an interesting problem here because this problem says, what do? You have an accrual of a loss contingency, but it is tax deductible when paid. Does this result in a D or a T situation? And I'm saying if net income is going to be less than taxable income, then you call it a D. And if you call it a D because net income is less than taxable income, you know you have to add. So anytime you see a D, you're going to call that a deferred tax asset. And so work through this, and I will do a few of them with you. Accrual of a loss contingency, since it is only showing up in the taxes when we actually pay it, and you're accruing it, you're going to cause net income to be less than taxable income. You're going to have to add to get to taxable income, and that's going to create an asset. Prepaid rent, and this is you paying the rent. If you are paying the rent, then when you pay your rent early, it's going to show up as a prepaid item in your financials. but it's going to come off of taxable income. So it's going to be the very opposite effect as what you had in 1. 3 is going to be the very opposite. When you accrue bond interest expense, just like when you accrue a loss contingency, when you accrue the losses or the interest items, you are going to show that as a D, which means you need to add and create a deferred tax asset. The unrealized loss from recording investments at fair value, what about this? What does this mean? This means that you are going to adjust the value of the asset. And remember in the chapter, if you're so inclined to think about assets or liabilities, the associated balance sheet accounts that go with the transactions, you could do that. I think what's easiest though is to really look at the income statement and focus on the income statement. So here we're saying that you're going to have something which will show up as causing a reduction in net income, and it's going to cause net income to be less than taxable income. Because it's going to show up as a loss, it's also going to show up as a type of an accrual. It's an accrual of a loss sort of a situation. Now, when does it actually occur? Not till it's sold. And it hasn't been sold at that point because they're recording it as an unrealized loss. I think we had an example of warranty expense earlier in our problems, and so you should understand warranty expense reduces net income, causes it to be less than taxable income. Advance rent receipts on an operating lease for the lessor. Well, this is a complicated terminology here, but let's just say we got the owner who is going to be receiving rental revenue got the rental revenue early. Okay, they got the rental revenue early, and that's the situation. We talked about MACRS, and that's in 9. So in MACRS, you know that the taxable income is going to be less than your pre-tax accounting income, because pre-tax is going to have a lesser amount straight line taken out of it versus the greater depreciation taken out on the tax form. Okay, and there's an accrual of an expense there. So generally, when you see the accruals of expenses or unrealized losses or things like that, that becomes the D situation up there. They're all classified in the same sort of thing. Here we have Verifone Systems, a provider of, you don't need to know any of this. They're just a provider, and then they get, they reported current and long-term deferred tax assets totaling 513. They had valuation allowance of 418. What would motivate them to have a valuation almost equal to deferred tax accounts? Well, to update this for the current way of looking at things, we should not say they have current and long-term deferred tax assets. We should say they have deferred tax assets, and we know they're all going to be long-term because that's what our current accounting tells us. So more likely than not, there's a bunch of accounts where they think that they are not going to be able to realize the deferred tax assets as stated here. And then they go into what actually happened for the company that set them up for this. So they had operating losses, and when they did the operating losses, they created, I guess, deferred tax assets so they could carry it forward. And then they realized that, realized the bad word, they came to the conclusion that they may not be able to have profits in the next year to use them up. So they decided that they needed to bump it down, and that's what they discussed here. When tax law changes, what do? You need to go in there and you need to change it just as soon as you come to the conclusion that it's wrong. So at this point, they sold some lots, and these apparently is installment basis sort of a sale here, because he says in the prior year their revenue was recognized for 20 million, and it's going to be collected over the next 2 years, 10 million a year, I guess. And during the time period, though, they came to the conclusion that the tax rate has changed. So when they had it on their books, they thought originally that the tax rate was going to be 40%, and they put it on at 8%, and now they can see that they need to have on their books only a portion of that left, and so what they do is they figure out where they need to be, and then they do a reduction to get it to the balance that they want it to be at. So what you do when you work these problems is you say, where should I be before I go into that next year? And you adjust so that when you do your next journal entry to take it off, it's going to be correct. So they have to do a little bit of a catch-up here, a 4.5, because they thought it was going to be 40%, and now it's going to be 35%. Here we have a net operating loss of 25 million, and it happens to be also the same loss on their taxes as on their financial reporting. And in the previous year they had taxable income of 20, and then the year prior to that, I guess they had 15, and they had a 40% rate. So what they want to be able to do is they want to be able to show that benefit, and this operating loss they want to carry back. So what they want to do with this is they want to apply the loss, and they're going to ask for cash. We want cash. Okay, we want cash. And that, as I mentioned earlier, with the time value of money concept, is the better approach, because you're going to get the cash back for the taxes you've paid in the past, versus wait into the future, and then you have to show at the end of the tax reporting time that you have profit, and then reduce the amount you pay. So wouldn't you rather have the money today versus wait in the future till you pay your taxes? So in this instance, though, we have a problem, because we had 25 million in loss, but going back the 2 years, there was 20 and 15, or 35 million in income. So we can only get back the amount of our loss, and then only the taxes on our loss. So if you look at this situation, if they had had a net operating loss of 35 million, then they could have got all of the 35 million times 40% back. This particular year we have 25, and so we can only get 25 times the 40 back. Okay? It makes it sound like it's a terrible situation, but it's really not a terrible situation, because they only had a net operating loss of 25, and they're able to get it all back. It's just that they can't recover the 20 and the 15, and those rates, of course, times 40%. So what they do is they take the 25 times 40, and as we talked about in class, they record that as a receivable. Instead of income tax expense, it's income tax benefit. And so on the financials, you would show that as reducing the loss. How are the loss carrybacks and loss carryforwards recognized? And recognized means doing journal entries for financial reporting purposes. So here is another explanation, which says if you're going to carry it forward, you create a deferred tax asset, And then consider also, because it is a deferred tax asset, whether you need to have a valuation account. Because if you do not have profits in the next years, you have no taxes to be avoiding or reduced by that carry forward. This is an interesting problem here because we have a situation, and I apologize, in your packet sometimes when there are tables and we take problems from textbooks and move them over, it does this, it repeats it. So we only either need to look at the top 150, 250, 200, or we need to look at the bottom, your choice. But what we are saying here is installment income was 600. So installment sales, I don't like income, and installment revenue was in the first year, the originating year was 600,000. And then it actually gets collected in the next years. When it gets collected in the next years, we expect the tax rates to be 30%, and then it's going to change in 2018 to 40%. I want you to understand that this is enacted law that says the tax rates are going to be this way in 2017, 2018, 2019, and today we are in 2016. So in 2016 we're looking at it, and the law says in 2017, 18, 19, these are the tax rates that are going to be there. That's what it means by enacted. All right, in 2016 also they're telling us the rate is 30%. So when we have something like this, which is going to be a timing difference of 600, and another thing you ought to really do when you do this is to make sure all that 600 is going away in these years. So that's 450, that's 1 plus 150, that's 600. Okay, so we see that it reverses. We see it's all going away. When we do this, we are going to show the minus 600, right? Because it's showing up in pre-tax income as 600, and it's not going to be taxed until 2017, 18, and 19. So we're going to have a minus 600 there, and you're going to see that is going to be a temporary difference. But it also says we have pre-tax accounting income in 2016 of 810,000 in total. So I guess we're going to say 600,000 of it is for this installment, right? And 210 is from something else. Well, 10 of that apparently is interest revenue on municipal bonds. So interest revenue, just so you understand, on municipal bonds is not taxable because it is from a government entity, so we do not have to tax. It's not taxable to us. That's a permanent difference because we never pay taxes on it, but yet it shows up in net income. So it shows up in net income and it never flows out on taxes. There's a mismatch. It doesn't reverse. It's always there. So it's permanent. So when you do this setup, which is different, a little different from what we've done in the other ones, you're going to start with your pre-tax of 810. You're going to subtract out 10 for that interest revenue from municipal bonds, and then you're also going to subtract out 600 for the timing differences, and then you're going to come down and you're going to have a taxable income number. And when you do your deferred tax liabilities, because you're subtracting there, you need to take 150 times 30, I believe that's 45. You need to take 40% of 250, and I believe that's what, 100. And then you need to take 40% of 200, and that's 80. And those three numbers that I came up with combined is what you're going to put your deferred tax liability on the books at, because that's the way it's going to go away at. you're gonna have the 150 going away at 30%, the 250 going away at 40%, the 200 going away at 40. So you have to use those numbers when you put it in the bucket called the liability bucket to make it go away right. As we said previously, if the law changes, you go back and you look at the situation and you do a catch-up journal entry to make everything work right. What is a temporary differences and how is it described deferred tax assets? What is a permanent differences and all this stuff. Okay, so if you are working through this problem, you would have income tax expense as being a plugged number in this entire problem. It's not going to work out that you could start with your pre-tax accounting income and take it times the tax rate of 30% and get it to work, because you have a permanent difference. So I think my solution is down here. Something's happened here. Yes, here we go. So pre-tax accounting income, as we talked through, then you have the permanent difference, and then you have the 600. And I said make sure that these guys that come through here add up to that, and it does, and we could have a 0 over here. The taxable income number here is this, which is 200. So tax payable is going to be the 30% times the 200, which comes out to be the 60. How much do we put in as a deferred tax liability? I can see it's a liability because that's a minus. This is it, 45, 180. Just as I discussed, total it up, you get 225. So, we're doing the journal entry, 225, 60. This is a plug number. Now, if we went back up here and we looked at this thing, we'd say pre-tax accounting income is 810. I can take 810 times 30. Well, I can tell the last digit of that is a 3, right? And this is not right. Okay? So you can't do the shortcut to get to this number. When there are permanent differences, you cannot do the shortcut. And I'm encouraging you not to do the shortcut. How do we record this as far as net income? Well, it's not 800 here. I know you're tempted to put 800 there, but it is actually 810. And the tax expense is coming off of the journal entry. You cannot shortcut and take 30% of this and put it in there. You got to go back to the journal entry and look at it, because you have two things going on. You have permanent differences and you have timing differences. All right, this requirement 3 has been changed. Your all of your let's see, go back up here. I'll talk about this. All of this needs to be showing up as a long-term liability. This is a current liability. That's all we need to know at this point. So I'll tell you that this solution has been changed because GAAP has changed. So that solution is wrong. This is a problem where tax benefits where the IRS might challenge, and what do you do? All I want you to know in this problem is that you need to add across until you come up with the amount, which is 50%. And so they put the benefit amounts here, they put the likelihood in here. And this is similar to one we had earlier. When we get to 50% is where we could do it. I think 10 and 20 makes this 30% cumulative. Over here, 30 and 25 is 55 cumulative. Our number needs to be in here. We need something in here. They need to give us more numbers on the table, and that is what we would consider recording. Now, the actual benefit has to be calculated based on tax rates as well, And this say that it's written as the tax benefit. If it was not written as tax benefit, but it was written as some other type benefit, and then it say you need to apply the tax rates, then you would do that. This says the tax benefit is already calculated for us. So when we record it, we need to understand that we have to use the valuation account to look at the cumulative probability and to record that downward. So I'm not going to ask you to do this bit of that journal entry. I only really am interested in you knowing requirement 1, which is when you get to 55%. And again, if I were doing it, I would want to record the most benefit possible, and that is when I get to the 50% threshold, and the cumulative 50% is somewhere in here, so I do not understand why you would ever do this. I would find the number in here which gets me to my 50% and use it, record a greater tax asset. That you do not need to know how to do.